Welcome to the Opening Bell Report.
Okay, I want you to picture a stock chart for a moment, but not a normal one. I want you to picture a complete and utter disaster. We're talking a straight vertical line down. In a single day, really, just a matter of hours, this company's share price crashes by nearly 17%.
17%. That's $96 of value per share. Just poof, gone.
Just evaporating into thin air.
Yeah, that's the kind of chart that just makes your stomach turn. It's pure panic selling. You see headlines screaming fraud, the whole 9 yards.
Exactly. A total nightmare scenario. But here's the twist, and this is where, things get really weird. You flip the page, you're shaking your head, expecting to see a company in ruins.
Right.
You look at the actual financials, the numbers underneath that crashing stock price.
Okay.
And what do you find? Net income isn't down. It hasn't stalled. It has actually skyrocketed by 92%.
Which is just,
Yeah.
it's a massive headache-inducing contradiction.
Right.
I mean, usually when a stock drops $96, it's because the business is imploding. The factory burned down or the CEO just quit. But here, the business is exploding in the best way possible.
That's the paradox we're unpacking on this deep dive. We're looking at a company called AppLovin, ticker symbol APP. And the analysis report we're looking at paints this picture of a market that just split in two. The emotional market, which is terrified, and the fundamental market, which is, well, it's printing money.
It really does. It frames this whole situation as a battle between, let's say, headline fear and financial reality. You've got the market panicking over allegations. Basically, fear of the unknown.
Yeah.
While this report suggests this might be one of the most misunderstood opportunities in the entire tech sector right now.
So the mission today is pretty straightforward, but the stakes feel high. We need to figure out, is AppLovin just another risky ad tech play that finally got caught? Is this a house of cards?
Or is this something else?
Or is it actually an AI monopoly that's so efficient people just don't believe the numbers can possibly be real?
And that too good to be true idea. That's really the anchor for this whole discussion. We're going to try and look past the red on the daily chart and focus on the green reality of the cash flow. Because, as the report puts it, we might be looking at a cash-generating machine that is currently on sale because everyone else is running for the exits.
Okay, let's start at the foundational level. Because if you asked the average person on the street, or even some pros, what AppLovin actually does, they'd probably just shrug and say,
Oh, they're an ad tech company. They put annoying ads in mobile games.
Exactly. Which is, technically true, but it's like saying Amazon is just a website that sells books.
Right. It completely misses the massive engine that's driving the whole operation. The analysis argues that treating AppLovin like a standard ad tech company is a fundamental mistake. This isn't about banner ads. It's about a piece of tech called AXON 2.0.
AXON 2.0. It sounds like something out of a sci-fi movie. So let's break that down. What is it exactly, in simple terms?
Okay, think of AXON 2.0 as a highly specialized prediction engine. Most ad companies are just serving ads. They have a space, they put a picture in it, and they hope you click.
Right.
AXON 2.0 is an AI that is actively trying to predict the future. Its entire job is to predict what a user's going to do inside the mobile gaming world.
Okay, predict behavior. What does that mean in practice?
It means figuring out who's going to do what before they even do it. And the report claims this system does it with a level of accuracy that's actually superior to giants like Google or Meta, but specifically in this one niche.
Whoa, hold on. That's a huge claim. Better than Google. Google knows everything I search for. Meta knows all my friends. How can a gaming company possibly beat them?
It's all about specialization. The type of data and the specificity of the model. Google and Meta are generalists. They're trying to sell you everything from shoes to cars. AppLovin is a specialist. Yeah, they have this walled garden of gaming data. So they're not just looking at what you like in general. They're analyzing millions of data points to figure out who's going to install a game, who's going to play it for more than 5 minutes, and this is the holy grail, who's going to spend actual money on in-game items.
Ah, right. Because downloading a free game is one thing, but buying the Sword of Ultimate Power for $10 is a totally different behavior.
Exactly. And that difference is everything. The analysis uses this great analogy. While competitors are just throwing spaghetti at the wall to see what sticks, AXON 2.0 is basically a sniper.
Okay.
It targets the whales, the high-value spenders, with extreme precision. It connects that high-spending player with the game developer who needs them.
And that creates a moat, right? That defensive advantage investors are always looking for.
Right. It protects your business castle.
Yeah.
The report points out that a lot of AppLovin's competitors are still stuck using manual targeting like literally humans guessing or older algorithms. AppLovin's system is a self-learning neural network.
So it actually gets smarter the more it works. It's not static.
Exactly. It's a flywheel effect. And this is a crucial concept to get. The more data AXON 2.0 processes, the better its predictions get. The better the predictions, the more money the developers make.
Mm-hmm.
And because developers make more money, they give AppLovin more of their ad space. That ad space generates more data, which feeds the AI, making it even smarter. It's a self-reinforcing loop.
So it just spirals upward.
Yeah.
And you can't just build that overnight. Even if a competitor stole the code tomorrow, they wouldn't have the years of data to actually train the AI.
Spot on. The code is useless without the data history. That's why their revenue is up 68%. In a mature market like advertising, that kind of growth is just unheard of.
Wow.
The report uses a phrase I really like. It says the AI is effectively printing money by automating the search for high-value users. There's no human guesswork. It's just pure automated efficiency.
Okay, so we've established they have this secret weapon in Exxon 2.0. But in tech, you're only as good as the next guy trying to eat your lunch. So how do they stack up against the competition? If they're this good, they must be crushing them.
Right. That's the real test.
Yeah.
And the analysis sets up this fantastic showdown. It puts AppLovin up against two of the darlings of the industry, Unity and The Trade Desk.
Let's start with Unity. Ticker U. I know Unity. If you play mobile games, you see that logo all the time. They build the engine the games run on. You'd think they'd be the kings of this space.
You would think so. For a long time, Unity was the infrastructure play. You know the old saying, in a gold rush, sell shovels. Unity sells the shovels. But the dynamic has shifted violently. The report puts it bluntly. Unity builds the games, but AppLovin makes the money.
Ouch! That's a brutal way to put it. So why the disconnect? Why isn't the shovel seller getting rich?
It's the business model and execution. Unity is mostly a software-as-a-service company. They charge for seats, for usage. It's a tough business to scale profitably with huge overhead. And, I mean, look at the stats provided. Unity's growth is struggling at less than 10%. Their profitability is negative or just breaking even. And what's their big solution to fix it all?
Layoffs. I've seen the headlines.
Exactly. They're firing people to save costs. They're trying to cut their way to profitability. That is rarely a sign of a thriving company.
Okay, so now let's contrast that with AppLovin.
AppLovin is doubling their profit. And here's the kicker that just blew my mind. They're doing it with the same headcount. They aren't hiring thousands of new people. They're letting the AI do the heavy lifting.
That's the definition of operating leverage.
That's it. Operating leverage is when you add revenue without adding costs. So every extra dollar AppLovin brings in flows almost straight to the bottom line because the AI doesn't need a salary or health insurance, and it works 24/7.
So Unity is manually cutting costs, while AppLovin is just exponentially scaling revenue on a fixed cost base.
It really shows the difference between a legacy software company and a true AI native company.
Okay, what about The Trade Desk? Ticker TTD. This is the one Wall Street adores. It's the golden child.
Oh, absolutely. The Trade Desk is a fantastic company. We're not here to bash them. They're the leader in programmatic advertising, buying ads automatically across the whole internet. But the report argues that if you look at the tail of the tape, AppLovin just wins on the metrics that matter.
Okay, break that down for me. Growth.
First, growth. The Trade Desk is growing in a very respectable 25% or so. Steady, healthy. But AppLovin, they're growing 3 times faster.
3 times? That's not a small difference. That's a completely different gear.
And then you have to talk about margins. This is where the business model difference really shines. The Trade Desk is like a middleman, a broker. They take a cut. So their net margins are around 20-25%. Very healthy.
But AppLovin?
AppLovin operates with 60% net margins.
60? That sounds absurd. That's software monopoly territory. How is that even possible in the ad business?
It's that walled gardener we talked about. Because they own so much of the ecosystem, they just keep a much larger slice of the pie. For every dollar that comes in, 60 cents is profit. It's incredibly rare. And yet, and this is the key to the whole contrarian idea, AppLovin is valued much, much lower.
So we're talking about the stock price relative to its earnings.
Exactly. We use the PEG ratio, price earnings to growth. It's the great equalizer. It tells you how much you're paying for each unit of growth. A PEG of 1 is considered fair.
And the Trade Desk.
The Trade Desk trades at a massive premium, well over 1.5. Investors pay for that safety. But AppLovin, their PEG is under 0.5.
So statistically, AppLovin is priced at a 50% discount compared to its growth rate.
Yes. It is significantly cheaper than the darling of the sector. Even though it's growing faster and is more profitable, it's a total value anomaly. It's like finding a brand new Ferrari selling for the price of a used Honda.
Okay, I have to play devil's advocate here. I have to. Because if I'm a listener, I'm thinking, if the numbers are this good, 60% margins, huge growth, AI dominance, why on earth did the stock crash $96 in a single day? The market isn't stupid. There has to be a catch. We need to talk about the elephant in the room.
We do. We can't ignore the crash. And this is where the story gets dramatic. The crash wasn't caused by bad earnings. It wasn't the AI failing. It was caused by a short report.
For anyone new to this, can you just quickly explain what a short report is?
Sure. A short seller is an investor who bets a stock will go down.
Huh?
And to help that bet pay off, they'll sometimes release this public report explaining why they think the company is bad or even fraudulent to try and scare people into selling.
So it's basically financial warfare.
Correct. And this specific report, it didn't pull any punches. It alleged that AppLovin's numbers are essentially fake. They used incredibly charged words like money laundering and claimed the growth is just too smooth, too good to be true.
The too good to be true argument. You can't possibly be making this much, so you must be lying.
That's the core of the bearish argument. It's just disbelief. They look at the 60% margin, they look at the AI's efficiency, and they say, no, that's impossible. No one has 60% margins in ad tech. It has to be fraud.
It's interesting, isn't it? When success becomes its own worst enemy in the eyes of skeptics. But our analysis has a rebuttal. What's the bull case? How do they prove the money is real? Because you can fake a spreadsheet.
You can fake an income statement, sure, but it's really, really hard to fake a bank account. The rebuttal in the analysis is all about hard assets. First, the numbers are audited by a major firm. But beyond that, you look at what the company's doing with its cash. The report notes AppLovin has $1.6 billion in cash on hand.
That's a lot of cash, but just having it doesn't prove it isn't, dirty money, right?
No, but the logic check the analysis uses is about the buybacks. AppLovin is aggressively buying back its own stock.
Okay, unpack that logic for us. Why is buying back stock so important when you're facing fraud allegations?
Well, think about the psychology of a fraudster. If you're cooking the books, your goal is to cash out. You want to take money out of the company, you sell your shares and run.
Right.
You do not spend billions of real hard dollars buying back shares of your own supposedly fake company.
Because you'd be buying worthless paper with real money. It would be financial suicide.
Exactly. By buying back stock, management is screaming, we know the truth. We know how much money we're making, and at this price, our stock is a steal, so we're buying it ourselves. They're putting their money where their mouth is.
So the argument is a fraudster hoards cash or flees. They don't reinvest it in the company they're supposedly faking.
That's the logic. And when you combine that with audited financials and that massive cash pile, the money laundering claims start to look less like smoking guns and more like conspiracy theories born out of confusion.
Yeah.
The market just hasn't caught up to what AXON 2.0 can do, so they assume it's impossible.
It kind of reminds me of the early days of Amazon or Facebook. People didn't believe Amazon could make money for years. When a new technology creates such a huge step change in efficiency, it can look like magic or fraud to the old guard.
That happens all the time with disruptive tech. The old metrics don't fit the new reality, so the immediate reaction is just suspicion. If I can't do it, then you can't be doing it.
So let's pivot to the future. We've got a stock that's crashed to around $473. The analysis report calls this price a gift. Why?
It all comes back to the math of valuation. We talked about PE ratios, price to earnings. When the price drops, but the earnings stay the same or go up, that ratio gets compressed.
It gets squeezed.
Right. Before the crash, the stock was trading at a much higher multiple. Now, with the drop, the current PE is compressed to around 57 times earnings. But markets look forward. If you look at the 2026 estimates, the forward PE drops to around 34.
So 34 low. I mean, to a normal person, paying $34 for $1 of earnings still sounds expensive.
For a regular company, like a bank, yes, it's expensive. But for a tech company that is literally doubling its income, it is unheard of.
Okay.
The report emphasizes that stocks with these kinds of growth metrics, doubling profits, 60% margins, they usually trade at multiples of 100 times or more.
So you're essentially paying a value stock price for a hyper-growth asset.
That is the opportunity the report is highlighting. The fear has created a mispricing. The market is pricing in disaster. It's pricing in the fraud allegations being true. But the data is signaling pure dominance. If the allegations are false, the stock is just wildly underpriced.
And there's a price target mentioned, isn't there? It's not just about getting back to where it was.
No, it's not just a recovery play. The report predicts that once the fear clears, and they point to the earnings release on February 9th as a key catalyst, the stock isn't just looking to recover to 560. Based purely on earnings power, the target is $700 plus.
700. That's a massive upside from 473.
It is. And it's driven by the belief that the earnings will vindicate the company. You can argue with a short report, you can argue with a headline, but you can't argue with billions in free cash flow showing up in the bank.
Speaking of cash flow, there was a stat in the report's intro that just blew my mind. I want to repeat it because it puts the sheer speed of this company into perspective.
The velocity stat.
Yes. In the time it takes to listen to this deep dive, AppLovin will generate more free cash flow than most of its competitors do in a month.
It's a stunning way to visualize it, isn't it? It just reinforces that this isn't some speculative startup hoping to make money someday. It's not a concept stock. It's a cash cannon firing right now.
So let's zoom out. We have a company that's outperforming its peers, has an AI moat that gets stronger every single day, is sitting on a pile of cash, and is buying back its own stock. And yet, the market punished it because of a scary story.
It's a classic case of sentiment versus fundamentals. The sentiment is fear, the fundamentals are power. And usually when those two things diverge this much, it creates a huge opportunity.
It reminds me of that famous Benjamin Graham quote. In the short run, the market is a voting machine, but in the long run, it's a weighing machine.
That is the perfect quote for this. Right now, people are voting with their panic. They're voting based on feeling. But eventually, the market will weigh the cash flow. And this analysis suggests that when that happens, the scale is going to tip heavily in Aflape's favor.
It really makes you rethink the whole idea of risk. Usually, risk is a company that might run out of money. Here, the risk seems purely psychological, the risk of being scared out of your position by a headline.
That's a great point. The operational risk, the business failing, it appears very low based on the data. The numbers are incredibly strong. The real risk is volatility. Can you stomach the drop? Can you hold on when everyone else is selling?
And that takes real conviction, which is why analysis like this is so important. It tries to build that conviction on data, not emotion.
And it reminds you to look under the hood. When you see a crash like that, your instinct is to run. But if you lift the hood and see a Ferrari engine running perfectly, maybe you don't run, maybe you buy the car.
So to wrap this up, let's just summarize the main thesis. We're looking at what the report calls an AI software monopoly that's disguised as a risky ad stock.
Correct. The disguise is the sector. Everyone hates ad tech. The reality is the technology ACOS on 2.0. The drop is emotional, driven by allegations that the company is refuting with its own wallet. And the valuation is compressed to a level that implies very little growth, despite the company growing at a hyperspeed pace.
It's a compelling argument. It definitely makes you look at that big red chart a little differently. Instead of a warning sign, it starts to look like a for sale sign.
A discount tag on a luxury item.
Exactly. Well, we have unpacked the tech, the competition, the drama, and the numbers. It's a lot to digest.
It is, but the takeaway is pretty clear. The data tells a very different story than the ticker tape.
And that brings us to our final thought for today. We always like to leave you with something to chew on.
Yeah, the analysis poses a question that really cuts through all the noise. In a market driven by headlines and panic, who do you trust? Do you trust the panic on the news ticker, or do you trust the audited billions on the balance sheet?
That is the question. Money talks, and right now, AppLovin's money is screaming pretty loud.
Indeed it is.
Thanks for diving deep with us today. We will catch you on the next one.
See you then.
Don't forget to like, share, and subscribe for more.